Today, my webinar will be on a whiteboard, and it is a new technology I adopted, and I hope that it will actually give you a very um, real visual sense of what I am talking about. So I'll go through that process in terms of explaining from the structure all the way to what need to pay attention for this 2020, because this year has a lot of really important things to take a note. Okay. And the first thing we're going to cover, remember, we are talking about the tax structure and a case study on optimizing your tax structure. Therefore, you save more taxes, right? If our president can plan his taxes in such a way that in 10 years span, he only paid 750. And of course, nobody saw that tax return. There is no way I can place judgment on that. But I want to say that it's actually totally appropriate for someone to plan their taxes to pay less tax. That is different from me saying that it's okay to not pay taxes. No, it's not okay. And if we made money, we love to pay taxes. But when you pay taxes, you certainly don't want to end up paying tips, right? IRS don't need tips. IRS just need people to volunteer to go onto taxpayer advocacy panel and to serve them, but they don't need us to give tips. So you want to plan your taxes so well, and you know that you got hold of all the benefit that are out there for you. 2020 is such a weird year. I will tell you that if you end up paying taxes in 2020, you probably need to talk to me, because I am not convinced there is a company I knew that made more money than before. Of course, if you are a Zoom.com, you make more money because you are in the business to support virtual work environment. Anything that not related to virtual work environment and you don't make the same kind of money, your business changed. So when we talk about business change, and we want to first introduce to you what I called as tax structure. I want to give you all the regular tax structure so you have a good understanding. Then after that, we want to dive in examples. And examples of in 2020, what to save. Okay, so that will use up our time. So let's dive into a general question. What is tax structure? So I will draw this for you. So there is a sole proprietorship, am I right? And there is LLC. There is S-Corp. There is a C-Corp. Okay, folks, this is not the only 4 type of tax structures out there. There's a lot more, but we are talking about small business in general. Okay, of course, any of these tax structures, and you can elect them, you can apply for exemption. Then you can become a 501c type of entity. That's a nonprofit, right? So all of them eligible to do that. But let's say in general, when you run a small business, just for example, and if I run a small restaurant, okay, and I am these 4 type of entity, so I want to ultimately give you a bottom line of what's the difference on taxes. So let's say I run a small restaurant and my year-end profit, so let's put it this way, my sales is 200,000. So that's my sales. my expense come in, and let's say my expense took all of it out, left me with 10,000. So my profit is what? 10,000, right, folks? Under sole proprietor, you would pay income tax, and you also will pay self-employment tax, income tax. And our average income tax rate goes from 10% all the way to 37%. Okay, so this reflected the 2018 Job Act changes. So the rate is from 10 to 37%. And the 10 is from your revenue. If your revenue is less than 9,000 with change, then your tax rate is 10%. So now, what is self-employment tax rate? That always goes at 15%. So with that, we're going to make assumption. For example, we're going to say that our income tax rate is 20%. Okay, we're going to make a example, use one rate so we can reflect on the other calculation. So now our total tax rate equal to 35%. Am I right? So 10,000 profit times 35% taxes. So I pay 3,500 total on taxes. So that's the situation with sole proprietorship. So what happened? I'm running the restaurant, but I am doing a LLC. Okay, so it is an LLC. And if I am just myself, I am the single member LLC. Then your situation is going back to here is the same. Why? Because you are going to file Schedule C under 1040. Okay, so you would end up paying the same amount, just like that. Same. Then you say, oh, no, it is me with my wife. So two of us are running. So we file a partnership tax return, and she gets 5,000, I get 5,000. Right? Still 10,000 profit. And we both work there, so you would still pay because you file jointly, right? So it still end up as a 10,000, and it still end up paying income tax, the same, 20%. You both working there, self-employment tax, 15%. You still end up with 35%, and you still end up paying the same taxes. Okay, now you will say to me that, Ying, I don't understand why you even give this example because it's exactly the same. True. And when you both are working, that's what happens. But what if the wife here, she doesn't work in the restaurant? So her 50,000 and should not subject to self-employment tax. She should not pay. And right here, folks, when you have a partnership return, it is so important for you to figure out who is the one working. And to also figure out Who is the one watching? If the one is watching, should never end up paying self-employment tax. So in this case, the wife should not be paying. Then what do they save? Because it's a 5,000 times 15%. So you should save $750 on taxes. So 5,000 minus 75. So that will be what you should have paid if you were making your wife not self-employment taxable. So your total tax is 2,750. Okay. So now you kind of got a taste of the LLC. So in what case they are that way, in what case they are in pink. Now let's look at S-Corp. So the S-Corp also made a 10,000 profit. And you will distribute that. It's called a distribution. Distribution taxed at only income tax. Okay, so 10,000 times what? 20%. So what is my rate? What is my tax? 2,000 tax. Now you are like, wow, obviously it is so much better than $3,500 here. And it's better than here. And it's better than here too, right? This is the same. So it has the lowest rate. So you will say, what is the catch? What is the catch is before you arrive into the profit and you have your sales, 200,000, you have your expenses, but inside of these expenses, you must have a salary. If you are a one person running S-Corp, if you don't have a salary for yourself, this formula could trigger IRS to say, where is that reasonable pay? So you have to be reasonable to yourself to pay a salary. So this is where the S-Corp comes in. But one thing I want you to remember is whether it is S-Corp or sole proprietor, I'm going to draw a box here. See, I boxed up the S-Corp with sole proprietorship and LLC. Because this green box, every entity here they use personal tax table. You know, we have a different tax table in our tax system, right? So you have a personal tax table, which is going from 0% all the way to 37. Then you also have what we call the corporation tax table, which is the 21% flat rate since 2018, remember? So now let's look at the last one. So our last one is the C-Corp. We are doing the same. Oh, I want to change my pen color. I'm choosing brown, but it doesn't give that to me. Why? Oh. So, sales, I have sales 200,000. I have expenses. Let's say it is that. So my expense, my profit come in as 10,000. In C corporation, life is really simple. You just take the 10,000 times 21%. So your tax is 2,100. That's it. Okay? Straightforward. C corporation doesn't use the personal tax table. They have its own, which we already know is a straight line, 21%. Okay? And in C corporation, this is where a lot can be deducted, not just salary, can be benefit, and can be car. All of these things can be deducted. So you got your profit of 10,000, you pay taxes. So what do you have left? You have 7,900 left, right? In your bank account. If you want to get this $7,900 you left in the bank account to your personal pocket, you would write yourself a form called 1099 dividend. You would have to pay taxes again on your personal tax return because you got the 1099 dividend. Make sense? So this is where, if you ever heard of people talking about double taxation, that's what they're talking about. They're saying you pay taxes once, you pay taxes again, so it's double taxation. But let me tell you this, if your income is high, and to use C corporation, so you can keep the rate at 21% instead of 37%, that is a no-brainer. So people would move their income into a C corporation, and if that business purpose can be established. So now let's take a look at this whole chart we were drawing, right? And we have the we have the three entities over here, and these three, they are using personal tax table, and we understand how much they are charging from for tax purposes. So proprietor, we have two taxes, right? And LLC just depends, right? And S-Corp though, and of course only one tax is income tax. And for C-Corp, it's not apple to apple comparison. It is really a entity that on its own and with a 21% of tax rate. And if I take money out, I would pay dividend tax. But if I don't take money out, it will stay in the C-Corp. Okay, so this is where we generally discussed now about the entity types. Now I want to go into case studies and bring you on with one business. Then we talk about how this business is, what kind of tax strategy they are using, and we go from there to discuss details. Other than tax structure, folks, there's two other things I want to briefly mention before we go on example. Number one is fiscal year determination. Number two is accounting method determination. Both are important. One, you look at a business, and we will touch on that and the one we talk. So on the accounting method side, and you know that one is cash method, the other one is accrual. And for fiscal year determination just means that whether you're going to go for January to December, 12 months, or you're going to go to 12 months starting from any of the month, like maybe starting from February ends in January, or starting from November ends in October. So now let's look at the case. So I am actually saving what we are doing here in the folder so we can always come back to it. So that is our number one. So I got that saved, and we will clear our board and we go on to next subject. So our next subject is really related to how people plan. So I'm going to draw a couple of boxes here to get your understanding with me, and then we talk about examples. So my first box I draw here, this is 1040. That's our personal tax return. And on my left side, I drew two boxes. On my right-hand side, I drew one box. And this is 2019. And I have this example for you. So this is a family with a cafe and rental property. And a holding company. So cafe is here. Rental property is here. Holding company is here. So this is how the case is. So on the cafe, and this family, we will just call that John's family. So John actually invented a kind of coffee maker that would instead of steam the milk, and it would actually put warm milk in the coffee. Okay, you steam it, but they have a lot of foam. But this one he made, it is the same effect with steam milk, but it's a warm milk without foam. So it's a special maker. So he designed it, and that design of the coffee maker, it is held, the intellectual property is held here. So we call that IP for trade secret. So it is a cafe. So they have a special coffee maker, but they still sell coffee. And they still have expenses just like other coffee shop. And they also sell this machine. So this is the mainly what is doing right here. So now at the end of the year, this entity always make money. So we had a $30,000 net profit when we look at the financial statement. And this is a 1120S. Okay. And now this 30,000, it is what happened at the end of the year. We had a meeting. Okay, John, how much you make? And what's your financial statement? So the QuickBooks says that, oh, he made 30,000. And on the rental property side, this is 1065 because it's owned by him. This is him and this is his wife. So this is owned by both of them. And the property they're holding, one of the property, it is actually rented to the cafe. And the other property is a nursing home. Someone else's rental. And then they also have a apartment building. And this one managed by John. Okay, so John receives W-2 from his job. He has a very good job. He makes $250,000 already elsewhere. And this is John. And the wife has a small W-2. And this company give them a K1. And this company give them one K1 for John because the wife is not in the cafe. But on here, this company give them two K1. One is for John, one is for wife. Now, when we work on a tax planning, we need to know which one comes in to offset the income from the W-2 because they are already at $280,000. Their tax rate is at 37% already. Whatever comes in, if they are positive number, it will add on top of that, it will be taxed a lot. But if it is a negative number, and it will not be, it will reduce the W-2 and getting them more refund. So on the rental property side, and John has done a big renovation. That was almost $250,000. Okay? You know what? Let me change this. I'm going to change my year to 2020 because I was thinking of 2019 because I had that real numbers in the example. But to use 2020, then we can put in things that is relevant to 2020. Okay? So allow me to change my mind. I'm going to do that as 2020. So John did renovation for $250,000 in 2020. Okay, so now knowing all of this fact, I also know that this coffee maker is an intellectual property from here. So I need to get paid here because there should be a royalty charge for using the special maker. So I asked John, so what is the rate? Normally, let's say if you use something intellectual property protected, and if you use it, you pay a percentage of your sales to it. So what is that rate? John may tell you that, oh, that is like 5%. So that can be determined and that need a legal documentation, but the rate you can decide. So that may give us 5% of sales. So we times sales of the cafe. So that might give us 40,000. We're just gonna make that number up. Okay, so now with that, and I have $30,000 estimated. QuickBooks says $30,000 income. If I minus that by my intellectual property payment, didn't I have a loss of 10? The answer is yes. I would have a loss of 10. Then you probably say, well, Ying, what's the point? Okay, I put that in here, then I'm going to pay taxes on here. So let's say if you don't have any expenses, 40,000 times 40,000K times 21%. Is it less than 40,000K or times 37%? So that is where the consideration is, right? So our question to ourselves is that, is the $40,000 in here helps, or it goes to the personal tax return right here helps? So that's one determination we're doing. So I'll give a red. I'll say that's number one. We're considering. Nothing set in stone. We're just discussing, okay? We're just talking about options. Then the number two. And remember, John does this rental property, and normally it's sort of always break even. Like never really had much income, also don't have a lot of loss. So it's kind of zero in the past, kind of break even. But 2020 is going to be different because he did $250,000 renovation. So with CARES Act, it actually changed something called qualified improvement property. That's a term. And this one, the CARES Act said that you can deduct it using bonus depreciation. That means right in here, I have $125,000 loss to claim. I used to break even, but now with my renovation, I have a loss. So my loss came here. Instead of me with zero, now I am going to put in a loss of 125K. And right here, I already have a 10K loss. Now, with my income, 280 minus 10, 270, minus 125, so 270, and 125, and I end up with 140K AGI instead of 280. 150, I even qualified for stimulus check because it's below 150. Okay, so now you're wondering, so this is our thought of number two. So I just introduced to you a number two concept, which is the qualified improvement property, QIP. If you don't work with community CPA, when you go to your tax preparer, you need to ask them whether you qualify for this. This is huge. This one actually already in 2019, folks who filed 2019 late, you should already implemented that for your 2019 because CARES Act came to effective on March 27th. So starting from that time on, 2019, 2020, and those properties, and you can go back to correct them if you did it wrong. Because they used to be, the Job Act came out in 2019, made those property improvement to depreciate over 39 years. There's no way to go around that. So your tax preparer probably already did 39 years for you. which you only deduct a very little small portion. But now you know this is a CARES Act, and this is the number 2 concept I want you to remember. Okay? Now listen to me really carefully. What if I'm going to change my color because I want to talk to you about what if. So what if this family, John's family, didn't have this income? What if the only W-2 was the 30,000? Now we have all these laws coming out, and you see how I will have a negative AGI because my business has a loss. I have a negative AGI. Okay, folks, in 2018, 2019, 2020. Only these 3 years, folks. The CARES Act said if you have business loss, which you do, you have this, you have this. Okay? If you have a business loss in any of the 3 years, you can go back 5 years to seek for tax refund. What does that mean? Example, let's say in 2020, we end up with a loss of 100K. Actually, just calculate. So this is 135 minus the 30,000 payroll. So we have loss of 105K. So 105K, that's the loss, AGI, business loss, okay? So that, let's say if I have, this is 2020, okay? So 5 years before 2020 is what? 2019, 2018, 17, 16, 15. 1, 2, 3, 4, 5. So on 15, maybe you paid taxes because you made money. Let's pretend in 2015, you actually have 105K business income. On your 1040. And you paid, that time the rate was 39.5, was more than 37, okay? So 105,000 times 39.5. So you paid 42K taxes. Folks, you will apply for NOL carryback. It is called NOL carryback. You will do that and you get 42,000 in your pocket in 90 days after you apply. That is what I want you to know. Okay, so now I just mentioned to you number 3. Okay, so number 3 is NOL carryback. I give you the example how that would work. Of course, maybe your 2015 you only have 50,000, and so you get your taxes back for the 50. Then 2016 you have the other 50. Then you will get 2016 taxes back. Ladies and gentlemen, if you have not done that, if you didn't even know anything about it, and I want you to go back to look at your 2018 and the 2019, because this rule applies to 2018, 2019, and 2020. Don't forget, your 2018, you can go back all the way to what? to 2013, 5 years back. All right. So that is our number three. I really, really want to knock that into your conscious so you know what I'm talking about. And I really don't care whether you do business with us or not, but I want our people to have the knowledge. This is why Trump can get $750 payment to IRS and be a billionaire, and we small people paying so much taxes but no way lived in the way he does, right? So knowledge is equalizer. And I know I'm not the smartest person on earth. I don't know all the things, but it's my intention to give you everything I know so that you can at least think for yourself. And plus your own smart, you're going to do even better than I did, right? So that's why we are talking today. Now, let's go to my number four. So, remember we were talking about this holding company. It's holding on intellectual property and it's a C-Corp. And this C-Corp, it is so amazing and it doesn't pay any more taxes than 21%. I own it myself. John owns it. So it doesn't matter. He doesn't have to take money out. And this C-Corp has something really amazing. So this C-Corp has a tax year. Instead of all of our tax years is from January to December, right? Just like our personal. But this C-Corp is actually start from November to October. So the new year began on November 2020. So why do I care about that? Of course I do. Because you will know your profit and loss in cafe at the end of the year. Closer to the year end, you know how well you do. And you know that whether you have the money to pay the royalty or not. You may not have the money to pay. And your cafe is a cash method accounting. If you don't pay, you cannot deduct. So you always want to know whether you can pay or not. So let's say you made a good living, and so you are paying the royalty to the holding company. And if you pay that on November 1st of 2020, you have all the way to October 2021 to spend it. Am I right? To use it. Because your year just start in November. You don't need to pay taxes all the way to October 2021. And then 3 months and a half later, you file your taxes. So this is a delay in dollar to IRS. It's not that we don't pay taxes and you haven't really come through the process to have a 12 months behind you, then you pay taxes. So this holding company has something I call that physical year. It starts from November because I like it to start from November because by November I knew whether I can write a check for the royalty and to cash out of my bank before December so that I can deduct it on my cafe and also become an income for the holding company. Make sense? So this is my number 4. So I just touched on fiscal year. And I will elaborate fiscal year more here. When you have a fiscal year and you can delay your earning for more month to spend. So the idea is this. I want you to follow me to understand what I mean by fiscal year. Let's say I have a business. So this is January and this is December. This is next year January. Oh no, I mean this is next year December again. Oh, time just flies. I don't have enough time. This is another year of December. Okay, so that's just how life goes. So let's say you have a business that you make most money in April. So you have a lot of money made here in a very short time, and you want to have 12 months period right here, 12 months to be able to use it up. Then you will pay taxes at this time. That would be March 31st. This is the April 1st. Okay, so this is what we call the fiscal year. So you want to start your fiscal year from the time you make a lot of money, because you want your money to be made in this period. Then when you are lighter, because you're seasonal, so you can have time to spend all of the money, then you came up with a real year end to pay taxes. Otherwise, you could end up, let's say if you are a novelty shop selling Christmas decorations, and your fiscal year is December. Are you crazy? Are you out of your mind? And for two reasons. Number one, you're going to be paying taxes on all the sales you just generated. You haven't even have time to pay any bills. Number two, if you are on cash method accounting and the inventory, I mean, the vendors you bought your merchants from, you haven't even paid, you can't even deduct that. So there's so much thinking in terms of what exactly your business is. So that got to be a very important advice when you form your company, when you start running. But what if you tell me that, oh Ying, I'm so late now. I already ran my business for several years and I'm running it wrong. No problem. We can change it. You can request IRS to allow you to change your fiscal year because your business cycle is different. Okay, so this is where I want to elaborate a little bit more on the fiscal year end, so you know it is much more than just my intellectual properties from November to October. No, it is about every businesses. Okay, now number 5, I have one last one to show you. Number 5. So I'm going to write my number 5 here. And number 5 is related to this guy. And remember, I mentioned that this guy is running this cafe and he has client coming to him, pay for the cafe and buy a cup of coffee, and so pay him. And he actually have expenses that he incurs for all kind of things. And in his business, his income, most of his income are paid right on the spot. So he doesn't, even if he is on accrual accounting, his income is pretty much on cash basis. Am I right? Because you will never know whether Ying is coming over to buy a cup of coffee or not. You cannot accrue that income Ying gonna bring to you. So that business itself is a cash business. It's a cash method business. But what if you choose accrual method? The benefit of you choosing that is you would include those vendor bills that you haven't even paid yet. They're unpayable, but you can bring that into your expense, become your expense. Okay? And for the coffee machine, and John never really had anybody who comes order 100 of them. So he sell them one by one. Okay, and so he get money one at a time. But when he ordered the parts and the things that he needed, he actually advance order them in bulk, and now knows that if he is on cash method, he hasn't paid vendor, they cannot deduct that. So this is where accounting method is a way to think which is better for you. And doctor's office, what do you think about dentist office? Do you think they would be on accrual or they would be on cash? The correct answer is they should be on cash method. Why? Two reasons. Their income, they always know what they're getting because patient come in, they already bill the insurance, and the insurance do all kind of discount on them and then give them the dollar amount. But that discount is so complex, dental office don't even know what they're getting. They just kind of like, oh, okay, I got this, I got that. So they don't debate with the insurance whether the discount is right or wrong, but they just know what insurance are deposited to them, right? So they are on cash, so they don't have to count all the money they build, but it may not be the real amount. So that's why they're on cash. And also, dental office notoriously are okay in terms of cash flow. So when they buy something, they don't need to do payable in the long run. They pay it. They either borrow money to buy equipment, but they pay it. So they always can deduct the expenses right away because they pay it on a cash basis anyway. So with that, most of the dental office, physician office, office like the insurance reimbursement kind of business, they're all on cash. So that is where I want to say that the accounting method is embedded to every of these entities. We want them to get away from paying taxes too early and using the right accounting method. So this is where, in a nutshell, we did two slides. We were talking about the general structure. Then we zoomed into this particular example on a John's Cafe. I hope it brought to you 5 important considerations. Number 1, being you can work your way to a C-Corp. Number 2, being improvement property. Number 3 is NOL. Number 4, it is the fiscal year. Number 5 is the accounting method. And when you think of your business, think of all 5. And then you can come to me and let me calculate your taxes. That's when you will be sure that you didn't pay tips and you are paying the tax dollars that you should be paying. Okay? All right, folks. I am saving this one as well for us. And any one of you, if you want to see the drawings, and you can email Catherine and she'll email that to you. But of course, the best is still come to Ying to do tax planning. And we offer tax planning at our firm. And this is the method we're doing tax planning. With pandemic, I do a lot of whiteboard. This is my whiteboard tax planning. And if you are interested, and I'm so glad that you're here with me today. And I was a little worried about my technology today because I didn't know whether this will write really well. But I hope you learned some. And I will see you again next time. And we talk on webinar. Bye-bye.